Welcome to Mortgage Minutes, where we demystify the loan process for you. I'm your host, Austin Baker, along with my co-host, John the Monk.
What's up? All right.
What are we talking about today?
Today we're going to be talking about pooling your credit. Yeah, that's a fun one.
Interesting.
Exactly. So when you're getting a mortgage, a big part of the application process is pooling your credit. And it's really important. And people always ask, do I have to? Is this part of the application process? It is. So it's required. We need to do it. It's part of our fiduciary duty, our responsibility to help qualify you for a mortgage is looking at your scores. And it's always prudent to do that. Sometimes you might have fraud on there. Somebody opened a credit card in your name. Maybe there's a unpaid bill that you forgot about that we can easily get paid and get your scores, rescored, all sorts of stuff. So you need to do it. And when you're applying for a mortgage, we have to go ahead and pull that credit.
Yeah, a lot of people are, and rightly so, apprehensive to getting their credit pulled. You shouldn't just go around willy-nilly letting people pull their credit. But we get asked a lot about what is this going to mean? How is this going to affect them? Should they go ahead and let us pull their credit? They might not be buying for a few months. So that's what this video is about, is to put you at ease and provide a little bit of clarity what's going on here, what you should be worried about and what you shouldn't. So first, I think you've already answered it.
Yeah.
This thing's required.
Gotta do it.
Gotta do it.
Gotta do it.
We cannot pre-qualify you or give you a loan if we haven't pulled your credit. Next one.
So you see up here a hard pull. So in the industry, there's like a soft pull and a hard pull. But whenever you're applying for a mortgage, it's a hard pull. And so people are always kind of like, oh, what does that mean?
Right.
Is that going to affect my score somehow because I had a credit inquiry and things like that? But to get a mortgage, the quick answer is we do have to do a hard pull.
Yeah. And if you're not familiar with that terminology, hard pull versus soft pull. Hard pull is doing a full comprehensive check, and it's also showing that your credit has been checked, whereas a soft pull is not going to give you all the information. It's not as robust, and it's not going to necessarily ding your credit score. A hard pull can, and at some point eventually will, ding your credit, and that's what people are concerned about.
And we're going to give you some info on that real soon. But the next thing we have up here is unlimited. So the reason why we have this up here is a lot of clients, a lot of home buyers, first thing they do is they're like, hey, I'm ready to buy a house. My agent told me to get pre-qualified. All I know is my banker. So let me walk in a bank and get pre-qualified. But then they go back to their realtor and say, I got pre-qualified with my bank. What's the realtor going to say, Austin?
For the love of God, call these guys instead.
Call these guys.
So this happens a lot. People come to us. They've already been pre-qualified. They're worried about getting another hard pull done. But what do we know about the way that the credit system is set up for lenders?
Got a little window, a 30-day window is what we call it, where you can have unlimited hard pulls on your credit for mortgage inquiry purposes. And so that allows you to, maybe you got pre-qualified bank, but now you want to get pre-qualified with the mortgage lender like Austin and I.
It's not going to hurt.
Yep.
As long as we do it within 30 days. So your credit's not frozen, but your credit score is. And what that's doing is that's allowing all the lenders that you're talking to or banks to be on the same playing field, to know what your credit looked like before you entered into this process of starting to look for a house.
Yep.
So now with that, we've got some fun numbers for you, and this is what you want to pay attention to. 30, 60, 90, 120.
Yeah, so we just hit the first one. 30 days is kind of when you can have unlimited pools, like we said, and have other lenders look at your scores. And so knock that one out.
Yeah, so 30 is great. So from the time the first one's pulled to 30, if an unlimited amount of hard pulls happens, it's not going to hurt you. However, we click over past 30, and in this 30 to 60 day window, if another lender pulls, it's going to hurt. It's going to drop your score. But how much are we looking at on average?
On average, it's like 5 to 7 points.
Right.
So in our opinions, it's very insignificant. Even though some people might think 5 or 7 is significant, it's really not.
And it's a temporary hit. It's something that is recovered over time. So it's just a temporary, it's like pushing a ball underwater. Like it just goes under for a second and then it pops right back up over time. So in that 30 to 60 day window, this is basically a problem zone. You don't want to have your credit get re-pulled if you can avoid it. Sometimes there's something that was wrong on the information, social security number, date of birth, spelling of the name, address, any of that information. If it's discovered, oh man, that wasn't right when it was originally put in on your application, we need to update that. Yeah. Sometimes it's unavoidable, but again, we're talking about 5 to 7. We're not talking about a 50-point swing. We're talking about 5 to 7 points.
Yeah, and in most loan programs, you'll barely see any change in rates or pricing at that type of level. Mm-hmm. So the next one we have is 90. So
90 on average, this is about the time where that ball pops back up out of the water.
Yeah.
So it's pressed down here and then it pops back up here. So most of the time we see our clients recover if this happens after 90 days, credit's fixed if nothing else is happening.
Yeah, exactly.
So.
And that's a good to know. And then the 120 is our last number here to remember.
120. Okay, so before I doodle on it, 120 days is how long your credit report is good for. So after we do the initial pull, you've got 120 days to find your house and to close on it. If you don't close on a house within 120 days of your credit being pulled, that's okay. We're just going to have to re-pull your credit. Mm-hmm. So after 120 days, we got to re-pull. But is that a problem?
Not if it's after 90 days.
Which it is.
Yeah.
So by the time we get to that point, if we've already pulled once and we've got to pull a second time, not a problem, not the end of the world.
Yeah, those 5 or 7 points have already recovered, so your scores are going to be the same they were back here, unless something else has changed.
Exactly. So if you're looking at this going, okay, I'm thinking about getting pre-qualified, should I go ahead and let my credit get pulled? I might not buy for 6 months to a year. What do we say?
Earlier the better, always, because there's some strategy involved. If something's wrong with your scores, then we can take a couple of months to fix them, to deal with them. So you never apply for a mortgage too soon, in my opinion.
Yeah, it's always good to know what is behind that closed door. So that's what's going on with credit pulls for the most part. If you have any questions, you know how to reach us. We'll see you around. Adios.